Hi, this is Randy Finney with Right Side of the Chart, and this is an early session update for Friday, March 6, 2026. It's 10:01 Eastern Times. I'm starting the video, so we're exactly 30 minutes in the trading day. As I mentioned to you yesterday and again today, one of the posts, I'm going to have to cut out early today. I've had plans for months now in place to leave, so I'll be working up for another about an hour or so. I still have to put all my tackle together. We're going to be on a boat over the weekend. So let me just get this video out there quick, share my thoughts. And part of that is a couple things. I want to just empty my brain, just get things out to you, things to watch. Number one, first of all, I've had just a plethora of price alerts going off. Once opening bell rang, it sounded like, Grand Central Station with the alarms popping everywhere. Just saw a lot of stocks hitting support. Some of those are price targets on trade. I got the trades. I got a couple out to you. I won't be able to get everything out today. And others are many key stocks. I could just sit there and go through them. I will go through some of those. Now, here's my point is that in swing trading, those days where I have numerous key sectors, stocks, indexes hitting price supports, like for example, IWM hitting T3, little overshoot, that's to be expected, gap down, order imbalances anytime there's an opening gap. You're going to get, again, both man and machine, I like to say, stepping in and buying those dips. Again, it's been one of the most, I've said this repeatedly recently, one of the most ingrained patterns of dip buying that I can recall in decades. It's become the herd mentality, buy the dip, and no matter what the situation is, what the cause is. All right. So, and as I like to say, one of my many yogiisms that I've come up with, that works great until it doesn't, right? And so there's my point, that you reach at any point in time in the markets when the thing that has been working so well for so long stops working. So what the takeaway here is, watch that. Watch everything I've covered. I'm not going to do a 1 hour video right now. I don't have time. All the key sectors and stocks that have hit support today are at near. Remember, that's the big things I'm watching besides the indexes. Of course, that's first and foremost SPY, QQQ, IWM, large caps, small caps. I even look at the mid caps, but again, I don't keep it simple. I trade those, track those three big ones. Financials. And within the financials, I've given you the subsectors because I'm looking for, and I suspect that's where the next big shoe to drop is a credit event. We've already had a couple that kind of rocked the business, development companies, private credit. But I don't think that's over. And then, as I said, that would spill over, and it has, to the regional banks. That's also why IWM's are going down lately. The small caps, they're very largely exposed. Most of the regional banks are in the Russell 2000 index. So, all right, so let me go over the levels, tell you again, things hit support. That's why so far, since the market opened, we gapped down pretty good, but things have stabilized. And I think there's a good chance we're at that point where support levels will initially, like today, may just prove to be mere speed bumps on the path down to the next price targets. Excuse me, I had a little frog in my throat there. So, all right, that's where I think we're at. And unfortunately, after this video, this is where I leave you. Kind of like that movie, if you saw Jason Bateman and Jane Fonda, good movie. Adam Driver had a good cast. So after this video, I'm gone. This is the last update I can give you, unless I take a screenshot and get one more thing out to you today if I miss anything here. But this is the overriding factor. I'm looking. Crude is at, I have another monitor here. I watch I have multiple monitors. Down here in the bottom left, you can see crude just hit almost $90 a barrel. The high of the day looks to be about 89.68 or so. This is USO, the crude ETN. And as I said, you will see a sharp pullback. Crude has reached levels not seen now in quite some time. Like I said, we hit the 78 level, as I covered in the video yesterday. It was the threshold that, when you come up to it from below, historically triggers corrections, and even in the past bear markets. And so we've long, or just in the last couple of days or since yesterday, we've clearly exceeded that. Again, this is not the price of crude oil. This is USO crude track and ETN. But I gave you these zones. Years ago I created the red zones. We're well above the red zone. So here's my point, guys. I'm going to keep it very simple. Yeah, there'll be a sharp. They'll the powers that be will do any and everything in their power to bring this down, right? And there will be. Now I won't touch it. You can short it with, I'm using it as just a kind of a tell on the market. And so the damage has been done. Can it be reversed? Sure, but we'd have to crash all the way back down here. If this is just fleeting, that doesn't stop the world. It doesn't, really hurt economic growth. It's certainly helping our airline shorts. We got in front of that long before crude did this, long before the U.S. and Israel attacked Iran. We were short the airlines because the charts told us to be. And then, this fall, that certainly doesn't help them. Remember, airlines hedge, but they don't fully hedge. Hedging only works to an extent when you get these big moves. You get demand destruction across the board. So here's my point, guys. Again, I'm going to keep it very, very, very simple. Even if we pull back sharply, and the market could very easily pop pretty heavy on that. But as long as we remain in the red zone, above my orange zone down here, it would have to take a heck of a reversal. And I just don't think that's likely. There's an uptrend line we may pull back to. But I think it's safe to say we're going to have elevated crude prices for a while. The leadership in Iran's not going to lay down. And then there's all kinds of other things can go, foobar over there in the Middle East. So there's a lot that can happen. So here, let me do this for you real quick. As I like to do, let me just share some of my comments. I get some great questions, I think, put to me. And I like to share the comments. This one was, what are your thoughts on platinum and palladium? Platinum and palladium in particular seems to be a good support. I agree. I looked at the charts, both the futures and the ETF PALL, decent support. But this is me personally. I'd avoid them right now. Taking a position before the weekend. Especially because if you buy them today, you're taking a position before weekend. A lot can happen. Remember, as a swing trader, even a futures trader, this is the one time of the week that a futures trader doesn't have virtually 24/7 liquidity. It's one reason I love futures, because of, bomb goes off at 3 in the morning, our time, something really bad happens somewhere. Guess what? I have stop loss orders on futures that will be hit if I'm in on the wrong side of that trade. And likewise, if it spikes me up, it will take me to my price target. I get filled, and I get to wake up in the morning. Oh, that's good. So I didn't, stock market gap down 5-6%, and I happen to be, let's say in that case, long. I didn't wake up to a 5-6% gap down. If you have QQQ, you do. But where I'm going with that is the futures shut down Friday after, shortly after the close, and they don't reopen, especially equity. Most things open back up Sunday evening. So keep that in mind. Anything you take on today with this, geopolitical risk right now, guys, it can go the other way, but the risk, I went on to say that, the risk of something bad or worse happens in the Middle East that really rattles the financial markets. I say really rattles. Remember, we're S&P 500 still within spitting distance of all-time highs, guys. And this is what I continue to say. I don't listen to CNBC. I only turn it on in Bloomberg when there's a market moving event like a Fed meeting. I want to hear what they said and what they're doing, and then Powell's press conference or a big earnings report. I know, but what I have seen and heard, and I look at articles, the bobbleheads are still saying buy it. We're in a bull market. They'll keep buying this up. In my opinion, again, in my humble opinion, the risk is not being priced into this market appropriately right now. We're starting to see that. So where I'm going with that is I think the risk reward on most financial assets is skewed to the downside. Another way to say that, the risk of a sudden and sharp 10% move in a week, over next week, let's just say by the end of next week, in my opinion, again, it's just my opinion, is infinitely higher that 10% move is to the downside than it is to the upside. So I'd rather be caught short against big pop. There's not a lot that I can think of, and there's sometimes things you don't foresee that can happen that would cause that. Nor do the markets usually go up. They go up 10% a week. When they do that? They do that in a bear market or after a very powerful correction when sentiment is extremely bearish and short positioning is very high. It doesn't happen. I've never seen it happen with the S&P 500 still within spitting distance of all-time highs. So that's it. I view everything in trading and investing through the prism of probabilities. And so on that risk reward spectrum, I think the risks are still skewed to the downside. That's it. So you guys know the levels to watch. Like I said, a lot of things hit support today. I'll go over that. So should the stock market take it on the chin, that could lead to forced margin call selling. And in many of the recently crowded, overly bullish sentiment trades, such as the precious metals. All right. So think about that. When the S&P 500 recently made, and it's still right now, when it was making new highs, what was ripping? Silver and gold. So those have been correlated. Same kind of folks that are loading up in their Schwab, Fidelity, Interactive Brokers, Robinhood accounts that were chasing the gold and especially silver, going parabolic. Well, it stands to reason a lot of them probably have stock, the same kind of NVIDIA and the high-flying AI stocks. Maybe not all of them, but I think a good percentage. And it doesn't matter really, because at the end of the day, like I said, a broad-based, the risk of a broad-based sell-off is high. Remember, it's been a beautiful stock pickers market. Security selection over holding the indexes long or short, right? We know that. That's so well telegraphed. That's why I think it's getting close to the end. When the media starts crowing about it, from the rooftops, then that's usually time that whatever they're crowing about, it's time to get out. So it's usually over. All right. So and then so if you get what I call it's a broad-based sell-off, that's when everything falls kind of in tandem, all sectors. You're not going to have that easy stock picking, security selection thing on the way down. That's when I find it easier. I'll leave the positions I have on, if they're active swing short trades with price targets, OCO orders. One cancels the other. That means I have a stop loss, good to cancel, and a price target, final price target or targets, and they're good to cancel. So they get filled, but I don't, the markets tend to move fast and it gets a lot harder. When things have been slow for months now, the market's grinding around. I have more time to comb through individual sectors and find these individual stock trades I've been giving you, long and short. And it's easier to manage a portfolio of, a couple dozen individual stock positions. If and when things start to move fast, such as a broad-based sell-off, and same thing when you're coming off a low. We've picked a lot of lows in recent years. We've covered shorts and reverse long, and then it's easier to just load up on whatever index or indexes you think are going to outperform, typically the NASDAQ 100, sometimes small caps. And I like to use the futures or leverage, and because you're going to get broad-based buying. Same thing happens off a bottom, all right? So that's it. So broad-based means just about everything with a ticker gets sold except those very uncorrelated things. And if you look at, for example, wheat, what was it, just yesterday, the day before, covered this, told you, I recognized the recent divergent high, brought it back to a trend line, and then I covered it right here. This was even better support, 564. And look what wheat's doing. It looks opposite the stock market, right? Stock market's going down. Said, wheat's at that point where just like I like to sell rips right now on the stock market, rallies into resistance, buy pullbacks on wheat. So you made in just 2 days, a day? What was this, yesterday? 9% so far in wheat futures, or WEAT if you're doing that. So these are the things. And why am I okay with this? Because there's zero correlation to the stock market. Crude, like I said, crude isn't necessarily correlated to the stock market. However, it has an effect, but it's just like the bull bear ratios, the sentiment ratios that I tell you are 110% useless. I don't even factor any of it in unless they're at extremes. When they're at extremes, they're very useful. Tells you when they're at the rare extreme lows where everybody's bearish, at levels not seen in years, or vice versa, when everyone's bullish, then they're very useful, and you kind of know what's likely to come. Um, and so my point with crude is, go back to USO. When it's within a range. It doesn't impact. It's not bullish. It's not bearish for the market. It's there. We use it every day. It's a something. So, but when it gets high, then like I said, it permeates all aspects of the economy, and it's instant. It's about the one thing out there. Again, I've always said this is the best real-time inflation indicator because energy is one of the biggest components. Housing's the biggest, but the problem with housing is such a delay. There's no immediate measure. They use owner equivalent rent, and you can kind of get a feel what's going on, but it's really just such a slow indicator to try to. There's no real time indicator for the housing market at all, not even remotely close. So this one is, and that's it. All right, I've said enough on it. And again, I expect it to pull back. No, I wouldn't short it right now. You can if you want. That's your thing. I don't. That's just I don't see it in the charts. I'm more watching this to know that, let's just say come Monday when I get back, Tuesday, anytime next week, it does this and the market has a big rally. Well, we're still well into the red zone, right? And crude is still high. Plus, it already hit that threshold that has triggered bigger corrections, as I covered yesterday. What was the 78 level, I think? All right, so that's it. I spent enough time there. Let's move on. Let's go to, I'm just going to rifle through various price alerts that have went off today. There's Morgan Stanley. I've been bearish on the broker dealers in the whole capital markets sector. Just hit the 200s for the first time in a long time. And again, guys, I've covered this so many times. This is where, after being under the 200s, it took it back. 1, 2, 3, multiple months. These are, I'm circling, I'm highlighting every single pullback. And then I've got a point I'm going to make. So, and I'm speaking, and I'm not being facetious. For those of you who are bullish and think the market's going to shrug this off and go to new highs, if you don't buy here, when do you buy? This is the first pullback to the 200 since it recovered them all the way back in May of last year. On a, if you were using this as your methodology for going long, if you don't buy here, when do you buy that? But as I like to say, and I started the video saying, we may be getting to that point where support levels only act as a mere speed bump on the way down. So, like I said, I can make a case to step in and buy here. I'm not buying it. One thing, I'm leaving town or going, in the same county, out on the for the weekend. But it's also a Friday. It was really good support. I had price support there as well. This wasn't just a random level. You can see I created this level here, this line back on in November 2025. That's my first target there, 158.14. We're at 158.70 right now after a brief dip below. So that's the takeaway. That's what I'm trying to show you. A lot of things hit support. That's why they're buying the dip so far. Not aggressively. I'll get to the 1 minute charts in a second. Let me just rifle through some other things. ATX. Junk bonds, I'm watching very, very much. Finally seeing junk bonds have broken out. They had a comparable trading range. This is JNK. There's two big junk bond ETFs, JNK and HYG, two different companies. And just like the stock market, for those of you not familiar, junk bonds, those are below investment grade bonds, anything below BBB rated. It's in what we call fixed income class. It's debt. And however, unlike all other bonds, treasuries, investment grade corporates, municipal bonds, those trade almost directly as a direct inverse correlation to interest rates. That's the one and only thing really, mostly. Now there's a little question about us, U.S. starting to print money and debase the dollar to finance, our huge deficits. But let's not go there. That gets a little more complicated. But typically, interest rates go up. There's a set formula on bonds according to their duration. The duration is how much a bond moves in percent in reaction to a change in interest rates. And typically, the longer the term bond, the higher the duration is. So a 30-year treasury is going to move more in price to an increase or a drop in interest rates versus a 10 or even a 5-year bond, right? But this is junk bonds. What I was getting at, they are an exception. They trade almost much closer to the stock market because they're paying such high yields. The market's not concerned. They're not as rate sensitive. They're more sensitive to changes in current or perceived credit conditions, right? I.e., to the economy and the stock market. Because when the economy starts to turn down, bankruptcies rise, and then all these companies, the reason they're called junk bonds, they're not complete garbage. They're great to own at the right time. They pay much better interest rates than safe haven treasury bonds or investment grade bonds. But the problem is default rates start to spike. And so that's an early tell in the market. And you can see that junk bonds have broken down. HYG, same thing. You can see we have a trading range. And by the way, guys, it's not mere coincidence. They've been in a trading range, and so has the stock market. And so I just want to point out they've broken down. Now they can recover that level, but unless they do, that's net bearish right there. So what else do I have for you? Let me rifle through. I've got a lot to cover. I already covered Southwest, heading down to T3 now. Remember, I told you that airlines, I like to do a shotgun approach, because there used to be, it was FAA, I believe, an airline sector ETF. There's not, somebody put out one, there's one but it's airlines and other things. It's not pure play on the airlines. So I like to short UAL. I gave you targets. I told you could take them all. So we've already hit my second target on UAL, LUV, a couple of them. I gave you official targets. Ryanair, we're coming up on that target there. American Airlines just hit that $11 target I gave you there, breakdown back test. And so the takeaway here, and that's a lot, it's the same target I gave you. I went over these charts before. So a lot of stuff hitting support right now. So the odds for a bounce are very high at this point. The $1 million question is, how far does it go? And that's where I wanted to leave you before I leave town, that if and when, I'm just tweaking some levels here on SkyWest, if and when, so right now was today's lows where most things hit support right after the open. If we get just a half-ass bounce and going into the close today, because I'm not going to be around to post this, and we smash down and close below those support levels, that is a change of character that we haven't seen in a long time, because forever and a day, for a long time now, buy the dip has been the golden mantra. You just do it. Don't question it. Doesn't matter how bad the news was that day. Bad earnings from a big company, bad economic report, bad jobs report. Doesn't matter. Hasn't mattered. But that's the thing. When it does, it's a change of character in the market. And at that point, the sooner you recognize that buying the dip isn't working anymore, the smaller your losses are going to be if you've been buying the dips, and the more profitable your short trades will be if you're a flexible trader. All right, let's move on. Let me just see if there's anything else worth. Let me just do a quick overview. I haven't before I leave town there's QQQ. We're still in the trading range. Nothing, no big deal, right? From today, it's just a down day. But again, that I'm seeing risks that the market's not. I think they're, again, dismissing what the conflict in the Middle East has done already to crude prices and may continue to keep them elevated. And I promise you, I've been doing this a long time. Talk to anyone who's studies economics. Persistent high crude prices, even I've showed you, usually just hit that threshold, and that's usually enough to do the trick. It will at least give you a decent correction in the market. So here's the S&P 500. Look, no big, as I'm leaving town, we're cutting out early today. We're right back to the midpoint of the trading range. So no big deal, right? It's a down day, but it's nothing big. 1% drop in the S&P. Like I said, they came in after the open because so many things hit support. I had all those price alerts going off. I didn't finish. I could sit here forever, and I had over a dozen go off today. And that's it. And as I like to say, support is support until unless broken. The midpoint of the range I've been harping on for months now as being support level, bullish when you're up above it on that upper half. And once you take it out, you usually go down to the bottom. And so it's resistance from there. So that's it. So these are the things to watch. Pretty much, again, if you see a dump today in the market below the close, below today's lows on most key stocks, sectors, and the indexes, that means a good chance we'll probably hammer down on Monday and hit the bottom, I would say, within a day. Be a quick move down. And then ultimately, I still expect to break below. So it wouldn't surprise me to see little, if any, reaction down on the bottom of the range. However, if we close up on or above and QQQ remains in its trading range and all these other stocks that I have hitting price targets today hold, well, it can go either way. And that's why, you go into the weekend, I like to go light if I don't have a high degree of confidence. I can sit there and trade off my phone today, bring my laptop if I want to. And so I'm just going to kind of see how the market closes today, and that'll determine how net short I go home, whether it's aggressive or mild. Still not, like I said, it's not an all-in moment unless we lose the 200s and the bottom of the trading range in QQQ there. But that could easily happen on a big gap down as well. So that's why I'm trying to get this video out and saying let's see what happens. And again, crude, I'm looking, still hasn't bumped, hasn't even reversed, and we're still at 88.80 right now. All right, quick view of the mags. Mag 7, NVIDIA smack in the middle of its trading range. That's this purple box right here. See it? Multi-month trading range. Going on almost, well, not a year yet, but close to it. And also holding the 200s. Remember, NVIDIA came back and it's been testing the 200-day moving averages as well. Needs to break that. Apple, dud. They just have their big event. And starting to take out this uptrend line off the April lows right now. Below that, that's bearish. Microsoft still below that primary purple uptrend line. That trend line goes way back, even to the left of this chart. So that keeps it in a bearish technical posture. Amazon still below the 200s. Again, all these have been covered. If you're new to the site, you just have to go back to the previous market analysis videos. Back test so far still below the 200s. That keeps that bearish. Meta, in fact, Meta still below the 200s also. See, 200 simple in blue, exponential in red. Broadcom just finally reported, last of the Mag 8 to report, and it's still below the purple primary uptrend line. That trend line comes off the 2022 lows, very well defined, but it's just really, it's testing it from below. That keeps that in a bearish technical posture because it's a back test of the trend line. However, it's successfully so far tested the 200-day moving averages. So this one really needs to take out the recent lows to increase the odds that it and the Nasdaq's going lower. Tesla also hanging in there like a champ, but just hugging them more. It's just on, just like here. It hugged the 200s for a while and then it started to rally. So that's what I expect. But if it goes this way, then that's bullish for the stock market, right? And the VIX still waiting for that 2862-ish level to go right there. Got a little purple trend line that's obscuring it a little bit there. But let me see if I can move that up. I got to go way back here. It was an extension of this trend line. The high today, this chart, I don't know why this platform delays this, but I also got plenty of live charts. There's the over here on the left. These are VIX futures. Here's the spot VIX. So it hit a high of 2867, right? And I've had that level there for how long have I had 2862 there? Created that back in 2022. Last updated it. If I tweaked it or moved it, it was in back in early August 2025. So to me, it's been a big level, still is a big level. It's what we kissed today. And guys, this is the takeaway. This is not mere coincidence. So many of my stocks, sectors, everything hit nice support. They're buying it. Again, I think it's a speed bump hit, not a hard stop where we're going to bounce. I give you my analogies. I define a reaction as one of two things: either when you go down on a stock or a security, an index, whatever you're trading, and you hit a support. I have the ping pong ball or golf ball, tennis ball analogy. You drop it on a concrete floor, it's going to bounce. Then I have the hacky sack analogy. When you have a rack, when you're heading down to something and you hit it and then you stay there, the hacky sack will just thud because it's full of sand. It hits the floor and doesn't really bounce. That's the more bearish of the two reactions. So far, little bit of a pullback, but I think that's a hiccup. And yesterday I made very clear in that video to tell you I don't expect, and sure, if it happens, it'll be an objective, another long entry on another pullback. But I've been highlighting these pullbacks to the trend line since I started noticing it. Told you each and every time, objective long entries. So if you bought that last one, which I highlighted right here, as I showed yesterday, you made that. Now, this is a level that it's been tapped on enough times that I think it's ready to pop. And so my expectation, again, is, and may not get it, I'd love to see it. A big dump into the close today in the market and see the VIX break out here. If it breaks that resistance, minor support right there. But that's my, so we could stop there, but I really favor a move up to that 60-14 target. That's going to be another 110% on the VIX. I'm going to say this because I always get these questions. If you're trading any of the VIX tracking ETFs, ETNs, even if you're trading the futures, they are not the spot VIX. You cannot, unfortunately, you, me, nobody can buy this. This is a theoretical index. You can look up the methodology online by a quick Google search, but you need to use a derivative to trade this index. A derivative is something that, as the name implies, derives its value from it. And those are the VIX futures, which I like to trade. And then you have the near month futures. Higher margin requirements on those, the March or the current ones. You can go out to the following month. The big juice is going to be on the near month contract. It's going to move up closest. Here, I'll show you an example. And then those VIX tracking ETNs, well, they have some that track the short-term futures. Again, they're going to have most of the March contracts now. And then they have midterm futures. They're going to be more in the April contracts. These are the futures right now, up 8.12%, and it's actually, they're tracking pretty close because they're getting close to their expiration. The March contracts are March 18th, so you've only got a little over less than 2 weeks, a little over a week to go, and so I just want to show you that's where the spot VIX is. Futures, they hit my resistance level again today. Tap, tap, tap. As I like to say, resistance is resistance until unless taken out. So maybe that's it. But if it breaks above, which I suspect it will by next week probably, then, like I said, it could be and should be a pretty quick run. And that's the thing about the VIX. If you're the waffling type that's indecisive and you wait too long, well, you missed it. It usually can get there in a day or two. That's what it's done the last two times. It took out this level right here. So, and guess what, guys? A couple times it looked like it was going to do it, and it didn't. It got rejected and went down quite a bit. Again, resistance is resistance until unless taken out. So my thoughts on it. To me, it's worth less. I'll tell you right now. I'm just going to say this. Nothing that happens today. This market, the NASDAQ can close up 3%. The VIX can fall all the way back to this trend line. Crude oil can fall back. Crude oil can drop. We're up right now as I speak, 9.43% on crude futures. It could close down 5-10% today. That'd be a 15% reversal, 15-20% reversal. And it's not going to change the impact. We'll still have elevated crude prices. So I still think it's favorable to be, again, there are skewed to the downside in the markets, but we're, like I said, we're still in the trading ranges. It's anybody's game, bulls or bears. In fact, the onus is on the bulls to pick it up here and get the NASDAQ down by the bottom of the trading range. Again, key support still above its 200s. You look at this chart, I can get the whole glass half full optimist thing, the people telling you to buy the dips, because you have the indexes, QQQ and SPY, above their 200-day moving averages, right? That's simple stuff. And SPY is much closer, making all-time highs right now than it is to, even breaking below its trading range because it's at the midpoint. But I want to show you something. I'm checking something myself, actually. Let's see here. QNQQQ. The MAG 8. How many do we have here? Capitalization. 1, 2, 3. I'm just counting Mag 8. We have only three of the 8 below their 200-day moving averages. So yeah, there's still, I'll tell you, there's still like I said, you can make a decent case, and you cannot make a crazy case to get aggressively short until this happens. So watch that. I've said the same thing over and over. See how the day finishes. They so far, the day is early, and they stepped in right at the open. It's again so many things hitting key support. I'll go over some of the financials real quick, so I got a little more time here. That's BIZD, which is in a very precarious technical posture. Strong positive divergence. Again, if they could turn this thing around. But there's BKX. This is the KBW bank sector. Just first hit of the 200 since all the way back here since it recovered them, right? So that, again, like I said in the beginning of the video, and I say it often, both man and machine, meaning humans, individual investors, both retail investors and professional traders, will buy pullbacks to the 200s, especially in a bull market, and especially when it's the first one in a long time. And machines or algos, trading programs, algorithmic programs, they're going to buy them as well. This is IAI broker dealer index. This one's below the 200s, but it's been dancing on this 165.17 support. So what I do there is I set a price alert. I probably already have one, but and then watch for a break there. That's going to get you farther away from the 200s and confirm that sector's broken down. There's insurance up about midpoint. I can always add these midpoint lines within a trading range, and they usually delineate the trend. That one's a little bit lower than the actual midpoint. IAI regional banks, I told you I've been very bearish on that because I told you I expected a lot of the spillover from private credit because both of these guys have their hands in the same cookie jar, a lot of the regional banks, and it's been nothing but a drop, 16.5%. But look where it is, 200-day moving averages. But again, I think these are going to be speed bumps, not reversal points on the way down to bigger one. Broker dealer, exchanges, credit services, insurance, KBE, the S&P, the Spiders S&P Bank ETF. So you've got them all here. The big ones too, like JP Morgan, which is now below its 200s. This is something to take note on, right? JP Morgan, first time it's lost to 200 since back here. And they had a quick drop after that. Wells Fargo below the 200s. Look at that beautiful breakdown, backtest, rejection. Citigroup. All right, so let's go back to that. That's KBE. That kind of shows you the bank sector as a whole. It could stick save. It's testing the 200 right now, right on the 200 simple, hair below it. So watch this one. So if we dump into the close, you're going to have more technical damage done to the market. That's the easiest way to say what's going on right now. KRE, regional bank sector ETF, that's a price target. I give you targets on this. I didn't label them, but I covered it in multiple videos. Sell signal there. There was your breakdown. First target hit, bounced as expected. Once that 67.98 target was taken out, went down, back tested, got rejected. Now we hit my 64.16 target today, plus the 200s. It's dual support. Price, defined by these reactions here, and 200-day moving averages, where they buy, in a bull trend, buy. And then once you take them out, like you did here, lost it, back tested, rejected. So if you missed the breakdown, you shorted the back test, you made 20% in just a matter of days, literally right there. It's about maybe a little over a week. All right, what else? Let me just finish with the financials here. PSP, private equity, still selling down. XLF, the main financial sector ETF, nothing but check marks so far. Well below the 200s. Makes sense, right? Because JP Morgan, the big ones are. Visa, I gave you Visa as an official trade idea in the sector. I've highlighted it several times recently. We hit T5. I told you at the time when we hit it, I drew a little arrow, expected a bounce. We bounced back to that T4. Former support becomes resistance. That was your re-entry point. So if you profited any or all of the, 17% drop, you could have gamed the bounce or just, covered there and then reshorted at a more favorable price. It's kind of like, being a long or a bull in reverse. When things get too far ahead and you hit a price target, you take profits, and then you re-enter that stock if you like it on a pullback to support. Well, when you're shorting, when it's time to cover because a bounce is likely, you can cover or reverse it and then reshort on your bounce back to resistance. You have both downtrend line and price resistance, and that's still my sixth and final target that I added on after the initial 5 targets. I added that on September 3rd. All right, I think look at specialty finance is just, and you hear it's funny, the cheerleading squad has come out in the media about, saw the headline recently, the lowest mortgage rates just hit their lowest point, and I don't know how long that was. I think last week's headline. Well, here's Rocket. These are your big mortgage companies that generate mortgages, originators. Rocket, it's at support, but look, I mean, it's just in free fall. Tells you what's going on in the housing market. 40% drop. UWMC broke support. It's that trend line clinging to this previous reaction low now. Any drop there, it's just lights out for that stock, in my opinion. PFSI, PennyMac Financial. I mean, look at these guys. Boom, they're just getting hammered. That's a 50% drop. WD, Walker and Dunlop. Look at that. All right, I need to move on. I got to get going here. All right, yeah, let me just wrap the video up. So that's it, guys. I'll wrap up here, and like I said, I'll, depending on what time we get back Sunday, if anything big happens by the end of today, I'll do a kind of a late, Sunday update for you. Otherwise, we'll pick things back up on Monday. This has been Randy Finney with Right Side of the Chart. Have a great weekend.